Real estate investment, fixed interest rates, mortgage loan terms. Get ready because it's time to raise the stakes with real estate. We are now going to look at variations that a loan can take, keeping in mind as we look at these that generally within a particular area, within a particular industry, you will have a standard structure, and then you could think about the deviations from, in essence, that standard structure. So in general, if you had two parties, a lender and a borrower, you can clearly think of many different types of loan structures and repayment structures that can be agreed upon as long as they're agreed upon between the two parties. But once again, within a particular industry, there's usually going to be kind of an industry standard. That industry standard is important because, one, there's probably a reason for the industry standard. It's probably the best type of loan in general, and that's why it's going to be the industry standard. And two, when you deviate from the industry standard, it's going to be a little bit more difficult to do comparisons because the standard is going to be what we generally think of, and there'll be more comparative terms to it. And usually when we deviate from the standard, then most likely we're taking on more risks in other terms as well, because once again, there's probably a reason for the standard loan to be the standard loan. So we'll take a look at some of the different structures we can have. We're going to be keeping the interest rate fixed here. So the interest rate will be fixed, and if the interest rate is fixed, then what are some of the components that can change? Now note, you could have loans where the interest rate isn't fixed. The interest rate could have a variable rate. That's not what we'll be considering here. We're going to be considering situations where the interest rate does not change over the loan term. So the components of the loan, we have the loan amount, which of course will impact the payments and whatnot. The loan maturity date, when is it going to be due by? The interest rate, which we're going to be keeping fixed here. And then the periodic payments, generally with installment loans for mortgages, you're talking monthly payments. That's generally going to be the case. Now, here's going to be the four categories that we'll be considering here. The first one is the option that's usually going to be the case. So if it's a fully amortizing type of loan, that's usually what we think of with an installment loan. So whether the loan is over 15 or 30 years or so on, it will then be structured so that at the end of that loan time, you will have been making monthly payments, which will result in the interest and the principal having been fully paid at the end of the loan term. That's how the amortization table will be structured. So in other words, every time you make a payment, there's going to be accrued interest. Remember that the interest represents kind of the rent on the purchasing power that you used in order to purchase the home. The interest then is not going to be reducing the loan balance. That's just rent that's going to go away. It's not going to reduce the liability. It's going to accrue upwards. The payment that you are making then is going to be over and above the accrued interest, and that means each time you make a payment, there's going to be a decrease to the loan balance. We will see this clearly when we make amortization tables, and we'll work a lot of problems with it. So I highly recommend looking at the practice problems. But we're going to be reducing the loan balance as we go because the payment's going to be higher than the accrued interest. The loan balance then will be decreasing every time we make a payment. The breakout between the payment and the interest will vary as we have these installment loans, which can be confusing. And the only way to get a good grasp of that is to work practice problems and set these types of things up, which we will do. But the idea is that at the end of the time frame, whatever time frame the loan is set up for, whether it be 10, 15, 30 years, if you pay off the payments, then you'll be fully repaid. Loan balance will be gone at the end of the term of the loan. Now, you could have a loan set up, and this would be a deviation from the norm, where you have a partially amortizing situation, meaning the rate is still fixed. You don't have a fluctuating rate, which would cause you more problems. If the rate was fluctuating, then you have more risk involved with the rate possibly going up in the future. In this case, you have the rates that's the same, but when you make the payment, you're still paying something that's over and above the interest rate the interest that has been accrued, meaning like the interest is accruing each period. You're going to make a payment that's higher than the amount of interest that has accrued, so the loan balance is still going to be going down. However, the loan balance is not going to go down sufficient for it to be fully paid off by the time that the period that has been set up, 10, 15, 30 years, whatever basically the setup is, which could result in this non-payment amount at the end. So at the end, at the maturity, it's not fully paid off, which could result in like a balloon payment type of situation. So that's another kind of setup that you can see, saying basically the idea being in that setup, if you had a loan set up that way, you'd be saying, okay, I'm going to pay the payments off at this point during the loan with a fixed rate, so I'm not going to be subject to the flexibility, but then I got that balloon payment that I know is going to be coming up at some point in time, and I'm going to have to pay that off or do something, refinance or something at that point in time in the future. And then we've got the interest only. If you're an interest only type of loan set up, then the principal basically never goes down. You would only be paying off the interest, in essence, the rent on the purchasing power of the loan. Therefore, each payment that you make would simply be like making the payment, not decreasing the balance of the loan. And when I say rent, I don't mean you're renting the home. I mean you're renting the purchasing power of the money that you then use to purchase the home. That's kind of like what interest is. And if you just pay off the interest, then if you had a loan set up in this way, interest only loan, then you would have that fixed rate, so you don't have that problem of the flexible rate in this case, because we have the rate that's fixed, but the loan balance isn't going to be going down because we're only paying off the interest portion of it. Therefore, at the end of the loan, the amount borrowed would be the same at the end as it was at the beginning. And then you could have a negative amortizing loan, and that would be a situation where you're still paying, you're making payments, but you're actually paying something that is less than even the rent on the money, meaning the interest on the money. You got the purchasing power, interest is accruing up, and you're making a payment, paying down that interest, but you're not even paying down enough to cover the interest. Therefore, the loan balance is actually going up by the amount of the interest that's basically not being paid off. That means that at maturity, you still have the loan balance out that's actually higher than it was at the beginning because you're paying less than even the interest on the loan. So just another recap of that we went over pretty detailed here, so I'll go over this a little bit more quickly. Fully amortizing loan, that's going to be the standard. That's going to be the general loan that you first think of, and then you can think about the variants. One of the common variants being that kind of balloon payment type of situation, which, you know, of course adds risks given the fact that you got that looming balloon payment generally at the end. So this is going to be with a fully amortizing loan. The borrower makes payments according to the loan's amortization schedule. We will work on making amortization schedules. That really helps to understand these things, to just put together some of these schedules. The borrower pays off the loan by the end of the loan term. So you got a standard kind of installment situation. By the end of the loan term, you should be at zero at that point in time if it was properly amortized. If the loan is a fixed rate loan, each fully amortizing payment is an equal dollar amount. That's generally how it will be set up. They make the payments the same. In order to make the payments the same, there will be a variant between the breakout of the interest and the principal portion. So partially amortizing loan, that's going to be that situation. We still have the fixed rate, but the partially amortization loan is another amortization-based payment schedule, except the entire payment isn't amortized, and therefore you'll still have part of it at the end. Instead, there is a set period of time where the amortization payment schedule is applied to the repayment of the loan. This may be any portion of the loan term, usually like 7 to 9 years. Partially amortized loans utilize payments that are calculated using a longer term than the loan's actual term. We might talk a little bit more about the calculations and the practice problems in future presentations, but you can imagine basically, you know, using a longer term amortization in order to calculate, and then having the shorter term, which would result in the amount that would still be due at the end of the term. So we may talk more about that in the future. But again, this is kind of a variant or a change from the normal loan. With these loans, the remaining balance of the loan is due at the end of the amortization period. So you got that amount due at the end, which is kind of like a balloon type of payment that you could result in that situation. And then we've got the amortization loans that negative amortizing loans. Now we kind of skipped the interest only loans, but those are kind of the basic ones. The interest only loans mean we just pay the interest, so the loan balance remains the same because we're only paying off the interest. A negative amortizing, the amortization means paying off a loan with regular payments so that the amount you owe goes down with each payment. That's going to be the general structure that would be in place normally. Negative amortization means that even when you pay, the amount you owe will still go up because you're not paying enough to cover the interest. So the negative amortization would be the situation where interest has accrued, you're making payments, but you're not even making enough to cover the interest, let alone the principal. that's going to result in the loan balance actually going up each period, even though you're making a payment each period.